Hi guys, in this recording I'm going to talk about how to buy properties under market value. My name's Adam Panisi. I share my knowledge of information that I've learned over the last 11 years being a property developer and property investor. So buying under market value is absolutely critical, especially for a developer where we rely on being able to make money from property development. If you're doing your own property developments or even wanting to buy your own home, you should definitely try and buy under market value, because most of the wealth for everyday Australians is made through property. So most of the billionaires on the BRW rich list are billionaires from property investing, property development, and those that aren't pour all their money into property. So a lot of people talk about buying property under market value. For most people that are looking to buy property, this isn't really that typical, because most people, what do? They go on realestate.com or Domain and they look for properties in a particular area and they think they're going to get a bargain on there. Now you might pick up a bargain on the open market, which is the retail market. You might get a bargain every so often. Now that the market has heated up and every man and their dog seems to be a property developer or wanting to buy property, it's a lot harder to try and get something under market value when it's on market. And I personally think, at the moment I'm not even wasting my time with any on market properties. Typically 95% of my properties I've bought off market, specifically targeted, or people have brought them to me. So they've been door knocked, we've negotiated directly with the vendor, and these have come to me via either an internal or external buyer's agent. So somebody finding me the site. So in my experience, getting a property off market is much better to buy under market value than trying to go on market. I have bought a couple of properties on market which have been absolute bargains, but that was when the market was a lot slower than what it is now. So those properties sat around and those vendors were conditioned. And also I had in the most two recent instances that I can think of in the last 5-6 years that I bought property on market, both those real estate agents that marketed the property didn't know the true value of the property. And so when I asked them what the vendor would accept or what their expectation was, I knew that value that they quoted me was well under what it was worth. So that's the only time I've bought on market, or other than buying properties through auctions from mortgagees in slow markets when basically nobody else turned up to the auction. I have done quite a few of those. I bought another property a little while back that was in termite fested. So in the early days I was buying a lot of my properties on market. In the last 6 years, out of the probably dozen properties that I've bought, maybe more, only 2 have been on market. So 2 out of, it's probably been more than a dozen. It's probably, let's just call it 15 for round numbers. I've lost count because a lot of the sites are amalgamation of multiple. So let's just say 2 out of 15 in the last 5 or 6 years have been on market. The rest are off market. And the half a dozen that we're negotiating on at the moment are all off market deals. So key number 1 to buy under market value, it's most likely you're going to get it in an off-market deal, either if you door knock yourself or if you have somebody else specifically door knock, or somebody bring you that property, like a site finder, or if it's somebody else's deal and they just want to flick it on and they want to leave a little bit in for the next guy. So what I was taught very early on by my mentors was that you make your money when you buy. The profit is in the buying. So if you can pick up an extra couple of $100,000 on the way in, that creates a buffer for you. If you are doing a development, it creates a buffer if there are cost overruns through the course of the development, or if there's time delays, and that can happen. Like, let's be realistic, you can make a whole lot of money from property development, but there are some risks associated with it, and you've got to mitigate your risks. And I find the best way to do that is to buy under market value. So you get instant equity, there's instant capital there before you even start. And the other thing I like to do is put a property under an option or a long contract, which I consider basically the same as an option. So getting a property subject to something, so on a conditional contract, and have a long drawn out settlement. That way you're not paying for the holding costs of the property, like the rates, the land tax, the stamp duty up front, the interest costs. You're not paying any of those until you actually need to when you settle the property. And then hopefully at the time of settlement, if you're going through to settlement and not passing it on, but at the time of settlement, you're ready to go with your development or your add value. So even if you're doing something like a renovation, if you try and get, say, a 3-month or 4-month window, you can plan out your renovation, plan your contractors, that way that as soon as you settle, you're straight into the renovation. I've actually done some renovations in the early days where we've gotten early access. So we've actually started renovating the property before we've even owned it, which meant that I had none of the holding costs of the property. So obviously this is only going to work in certain circumstances where the property is vacant, or the tenants or owner moves out of the property and they allow you to renovate it without actually owning it. That's actually been more common than not. It's probably been, in my personal experience, it's probably been more like a 50-50, where I've been able to get early access either to renovate or start doing works on site for the property development. And I think it's actually, a lot of people think that they're not going to get early access and they just don't ask. But if you go in with that expectation, you could save yourself, on a small project, you could save yourself 10 or 20,000 just in holding costs over a short period of time. Or a larger one, there's many hundreds of thousands, if not millions, in savings by delaying the settlement. My experience has also been long contract with the expectation that the market's going to increase. I don't put that into my feasibility, but I select suburbs that are in transition or in growth phases where I'm very confident there'll be some market growth over a few year period, the time that I put the property under option. One property I just settled recently, I had it under a 2.5 year option. I optioned it for 2.2 million on settlement, and I went through to settlement on this one. It's part of a larger site, so it's an amalgamation. So on settlement, no approval, so exactly the same site, the site's worth 3 million. So the approval is almost at completion. This is a larger project, so the approval takes a little bit longer. But there was 800,000 under market value. So an instant 800,000 equity that I used as a buffer, that was built in, and in reality that market hasn't actually gone up in the last 2.5 years. So that property, when I bought it, I knew it was actually worth 3 million, and that was 2.5 years ago, and that's in a flat market. So that market hasn't gone up in value, and it's still got valued. There's still 800,000 equity, so I bought it under market value. So that's all well and good that I'm able to do that, but how do then you take that and do it for yourself? My experience is that when you become an area expert, when you know an area or a pocket really well, you know the values of the properties. So when something comes up, you know instantly whether it's overpriced or it's a good deal. So you can spot the property when it comes up. One other thing is a vendor, a seller's expectation on price most people think their own home, in my experience, most people think their own home is worth way more than what it actually is. With the market increasing in most pockets around Australia, people's expectation, if they're actually sellers, is actually probably lower than what they're achieving in the current market. But generally speaking, most people think their property or their own home is so much better than everybody else's home and that it's worth so much more. When it comes to people's investment properties, however, they're not as emotionally attached to it. So there's not that expectation that the property's worth so much more than everybody else's. And I find a lot of the times people's investment properties, if they are sellers, they want to get rid of them, they're not going to be unrealistic about pricing. So that's one tip to being able to buy under market value. So buy people's investment properties where they're not emotionally attached to it, and there's a benefit to them for selling it. Maybe they've owned it for 10 or 20 years. A lot of the properties we buy at the moment are large land lots that we're doing either residential or commercial development on. And how we're able to buy these under market value is one we go and target, or we go to multiple properties. So we're not just relying on one person to sell us their property and hope and pray that they're going to sell it under market value. We go to multiple properties, we're in multiple negotiations, so there's options I'm talking about within the same suburb as well. So there's multiple options, which means that if somebody wants too much, you just move on to the next one. And maybe sometimes you've got to wait for those people to be conditioned to be realistic, so that you can buy something under market value. The other one is buying a property where people don't know the value from the general onset. And I'm talking about the general public don't know the value. But you know the value, one, because you're an area expert, but second, because you know the zoning, what's possible on that property. So to be able to find out or understand the zoning, you've just got to spend time looking at other developments. I've found that's the easiest and quickest way, is look at other people's developments, ones that are successful, run the numbers, work out how much profit they're actually making. Generally, the ones that actually get built are making money. So look at the ones that are built and then compare that with other ones, and then just do some rough numbers. Who's making the most money? What have they bought the land for? What do you estimate their build cost to be? And you can estimate build cost online. Just go to BMTQS. So that's a quantity surveyor, BMTQS. And they've got online calculators that estimate construction costs all around Australia. So estimate what their construction costs are, and then all the other costs. I normally wrap that up for small projects into one figure, and that's $140,000 per dwelling. So if you've got 5 dwellings, the soft costs, so everything you can't see, so excluding construction, so construction is one cost, and then all the other costs, interest, stamp duty, GST, land tax, holding costs, just ballpark number, $140,000 per dwelling. So that might sound high, and I'll explain in another video around costs and how that number is fairly accurate for most suburbs for small developments, and then work out the end price, what they've sold it for at the end. So I hope that's given you a great understanding on how to buy under market value. Hopefully I haven't overcomplicated it for you. I'll share some more information in other videos about other tips and tricks to buy under market value. If you are just buying a single residence, I'll share some more tips about just getting started on buying a single residence. I'll share that in another video. So thanks for watching. Have a great day.